This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the complex global landscape, focusing on the disconnect between strong U.S. economic growth data and persistent consumer anxiety over inflation and job market slowdowns, alongside diverging global central bank policies and the market impact of new regulatory shifts. Links and resources are in the description below. If you find this podcast helpful, please consider subscribing to the channel for more market updates. Okay, let's just jump right in. The biggest puzzle for investors right now seems to be the U.S. economy, the headline numbers. They look pretty fantastic, don't they?
They really do. On the surface, things look great. U.S. gross domestic product, the GDP, it grew at a strong 3.8% annual rate in third quarter.
And that's up from 2.5% in Q2, so it's accelerating.
Exactly. And the engine behind that is what you'd expect, consumer spending. It rose 3.5%, and that accounts for about 70% of all economic activity. So the machine seems to be running hot.
But that's the paradox, isn't it? If the machine is so hot, why does everyone feel so anxious?
That is the absolute core of the issue. And the answer, really, is what some are calling a K-shaped reality. That strong spending, it's not universal.
So it's concentrated.
It is. It's being driven almost entirely by wealthier, older households. They have the savings. They're less sensitive to borrowing costs. For pretty much everyone else, the pain point is inflation. It just won't go away.
And we're still seeing that in the Fed's preferred numbers.
We are. The PCE index, which is the one they watch closest, it climbed to 2.8% annually in Q3. That's still stubbornly above their 2% target. CPI was similar, 2.7% in November.
So this isn't just a feeling people have, it's real. They see it at the grocery store.
Absolutely. The polling on this is stark. We're talking 87% of U.S. adults saying they've noticed higher than usual prices on just basic necessities, groceries, electricity, gifts. It creates this incredible tension.
So wait, that K-shape, that has to be a nightmare for the Fed. I mean, if the wealthy are spending like crazy, you'd want to hike rates to cool that down. But if the rest of the country is already getting squeezed and the job market is weakening, a rate hike would be devastating for them. It seems like they can't fix one problem without making the other one worse.
You've hit it exactly. It's a paralyzing situation. And that's why I think we're seeing them pivot and focus more on the labor market concerns. That's where the cracks are really starting to show.
And they are definitely showing. Let's look at that jobs report. The unemployment rate has ticked up to 4.6%.
Which is the highest it's been since 2021.
And the hiring pace, it feels like it's just ground to a halt. Job creation has fallen to an average of just, 35,000 a month since March?
Yeah, compared to 71,000 before that. It's a huge drop. Analysts are calling it a low hire, low fire market.
Meaning companies aren't laying people off in droves, but they're absolutely terrified to hire anyone new.
Precisely. They're worried about high borrowing costs. They're worried about tariff uncertainty.
Yeah.
They're just protecting their margins instead of expanding.
And you can see that fear in the retail numbers. I mean, overall sales were flat in October, which was a big miss.
Yeah, and it's not just the big abstract number. You can see it in specific companies.
Like Cracker Barrel, right, I saw that. They lowered their revenue forecast.
They did, because traffic is down. Same-store sales dropped 4.7% for their restaurants and a staggering 8.5% for their little retail shops.
Wow. That's not people cutting back on a new TV. That's cutting back on a family meal out. It signals a really deep shift in how people feel.
It really does. Which brings us to the central banks, because they're all trying to navigate these very different realities.
Yeah.
And they're not on the same page anymore.
Not at all. Let's start with the U.S. Fed. They seem to be prioritizing the weak job market over that sticky inflation.
Clearly. They've cut rates 3 times in 2025, bringing the benchmark down to around 3.6%. The idea is to make it cheaper for businesses to borrow and, maybe start hiring again.
But they seem divided on what to do next in 2026.
Oh, very divided. The committee's views are all over the place, from holding steady to 2 or more cuts. For now, Wall Street is betting they'll hold in January.
So for people at home, what does that mean? Your high-yield savings account isn't yielding as much, but maybe there's a light at the end of the tunnel for credit card debt.
That's the trade-off. Savers get a bit less, but it's a positive signal for anyone with debt. Credit card rates, which are at a painful 19.88% on average, will come down slowly. The Fed is basically saying they'd rather risk a little more inflation than see the job market totally collapse.
Okay, now let's go global, because this is where it gets really interesting. The U.S. is cutting, but 2 other major economies are going in completely different directions.
The divergence is extreme.
Let's start with the Bank of Japan. They just did something they haven't done in decades.
It's monumental. They raised their key rate to 0.75%, a 30-year high. This is a fundamental reversal.
Why now?
Because after all those years of fighting deflation, they finally have inflation. It's stable above their 2% target. It hit 3% in November. This could be a huge deal for the yen.
And then you have the UK, the Bank of England.
A third path entirely. They just cut their rate from 4% to 3.75%.
But not because of jobs, like the US.
No, they're being very explicit. They're cutting to try and spur economic growth, and they're accepting the risk that it might fuel more inflation. It's pure stimulus.
So let me get this straight. The US is cutting for jobs, Japan is hiking to fight inflation, and the UK is cutting to boost growth.
That's it.
If you're managing a global portfolio, that's a mess. How do you even navigate that?
It means you can't just buy a global index and call it a day anymore. You have to be strategic. Capital will flow to Japan for the higher yield. Debt-heavy U.S. companies might get a boost. It's complicated. The old rules are changing.
And that complexity just gets worse when you add in trade policy. The tariff situation is creating so much uncertainty.
It really is. We're not talking about small numbers. Steel and aluminum tariffs are up to 50%, Canada up to 35%, and companies can't plan around that.
Right. It's not a risk anymore. It's a line item in their budget.
Exactly. Take a company like Wolverine Worldwide. They make shoes. They had to raise their prices by 5 to 8% last year.
And they froze hiring.
They did. Because they are budgeting an extra $55 million in tariff costs for 2026. And it's not just corporations. U.S. farmers needed a $12 billion aid package because of the trade war with China.
That's a direct cost that gets passed on to consumers or taxpayers.
Every single time.
Speaking of policy, there's another major shift happening in the auto industry with climate policy.
Yes, a big reversal. The plan is to weaken fuel economy standards pretty significantly. We're talking about dropping the goal for new vehicles to around 34.5 miles per gallon by 2031.
Down from over 50.
A huge drop. The argument is that it will make cars cheaper.
But is that even true? I've seen a lot of analysis that pushes back on that.
It's highly contested. Groups like Consumer Reports found there wasn't a big price increase from the old rules. In fact, they calculated that a 2021 car saved its owner about $7,000 in fuel over its lifetime compared to a 2003 model.
And this policy change is already having a real-world impact on investment, isn't it?
Oh, an immediate impact. In Michigan alone, it led to $540 million in canceled climate grants and $3 billion in canceled clean manufacturing projects.
$3 billion for EV and battery plants.
Gone. The shift in regulatory direction just killed that investment overnight.
And yet at the same time, some of these same geopolitical pressures are actually driving huge growth in other sectors.
Right. It's all about securing supply chains. Look at technology, specifically something like machine vision systems.
The stuff that powers AI and advanced manufacturing.
Exactly. That market is projected for 9.1% compound annual growth. It's going from about $16 billion in 2025 to almost $25 billion by 2030. That's just relentless growth.
And it's also boosting things like mining, right, for critical minerals.
Yes, especially for graphite. It's essential for lithium-ion batteries, and the U.S. is heavily dependent on China for it. With China putting on export controls, there's a huge new push for domestic mining.
So projects in places like New York and Alaska are suddenly getting fast-tracked.
They are. Federal funding, faster permitting. It's a clear pivot to bring that supply chain home, even while other green investments are being cut.
Before we get to our last section, we should touch on one quick regulatory fight that got a lot of attention. The attempt to defund the CFPB.
The Consumer Financial Protection Bureau, yeah. It was a very technical legal argument. The claim was that since the Fed had a paper loss from paying out high interest, the CFPB's funding source was technically gone.
But a judge shut that down.
A federal judge blocked the attempts, so their funding continues. It was an unusual challenge, though, and it highlights the ongoing tensions around these regulatory bodies.
Okay, let's wrap up by looking at two big global stress points. First, China. It feels like they have their own version of the U.S. paradox.
They do, but maybe on an even bigger scale.
Yeah.
The official government growth target is 5%, but on the ground, the sentiment is incredibly weak.
The property market is the big one, right?
Right. That's the epicenter. Prices are down 20%, maybe more, since 2021, and it's bleeding into consumer spending. Retail sales are slow, investment is down, and you hear stories about families cutting back on everything, even things like tutoring for their kids. It's a very tough situation.
And then on the far end of the spectrum, you have Iran.
Yeah, a truly extreme case of volatility. Their inflation rate, excluding fresh food, hit 42.2% year over year in December.
That's That's bordering on hyperinflation.
It is. And it's tied directly to geopolitics, the collapse of the 2015 nuclear deal and the sanctions that followed. It's just a tragic, powerful reminder of how quickly those events can turn into a dire economic crisis for millions of people. Many investors are thinking through what this volatile mix of domestic deceleration and global policy shifts means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments.
All right, that was a lot to cover. To bring it all home, let's just quickly recap the 4 main takeaways from this deep dive.
Okay, first, the U.S. has a major growth paradox. Strong GDP driven by the wealthy is masking deep anxiety for everyone else over prices, with PCE at 2.8% and a really weak job market, with unemployment at 4.6%.
Second, global central banks are going their own ways. The U.S. Fed is cutting rates to save jobs, but the Bank of Japan just hiked for the first time in ages to fight inflation, and the Bank of England is cutting just to spur growth. They're all on different pages.
Third, policy is creating clear winners and losers. Tariffs mean uncertainty and higher prices for consumers, and the climate policy reversal killed $3 billion in EV projects in Michigan, even as money pours into securing domestic minerals like graphite.
And finally, a couple of key global hotspots pose big risks. China is struggling with a weak property sector and nervous consumers, while Iran is facing near hyperinflation at over 42%, all tied to geopolitical risk.
I think the real question for 2026 isn't just about what the central banks will do next. It's whether the average U.S. consumer can hang on long enough for any of that policy relief to actually make a difference in their lives.
Thanks for listening to the 15-Minute Investor.